David, thanks so much for joining us on Wall Street Unplugged.
Good morning. Thank you for having me on.
So I want to start here because we've got so much to go into with Gold Royalty, chair and CEO, but you've been doing this for a long time, right? You almost your entire career, 30 plus years. I want to talk about the gold market and where you see gold prices, because no matter what stock you're running or what company you're running, a lot is dependent on gold prices. And you would think today, where quantitative easing every place, inflation really, even at the metric that the Fed created to show no inflation, which is CPI, it is at 5%. It's supposed to be, 2%. We know that the inflation is not transitory. We know the Fed is definitely going to keep rates low forever. But yet we're not really seeing that movement in gold stocks. So should we be looking at that as an indicator, or is it, hey, it's all really about the dollar inverse relationship? But how do you see gold? Because right now, for me, we should be well over 2,000, but we're not.
Yeah, look, I think some of the hesitancy around gold is the fact that general equity markets are still quite buoyant, and quite often gold is invested in an asset class in a volatile equity market. So the equity markets have been going in one direction up to this point, but I would say the valuations in the general equity markets have been stretched beyond recognition. A correction is inevitable there. And in the face of quantitative easing, debasement of paper currencies, low interest rates, you have to look at ways to protect your capital, and you should have a significant portion of your portfolio invested in gold. And when you look at gold as an asset class, if you buy into that investment thesis about gold as an asset class, there's various ways for you to play it. You can buy the physical quite readily. You can line up at a bank with your identification, pick it up and find a way to store it and incur the storage costs. You can buy the gold equities. And of course, what that provides you is leverage to the gold price and leverage to exploration success. But it also exposes you to inflation risk in operating capital costs. You could own the ETF, which is physically backed by gold. That's another way and achieve economies of scale in your storage costs because you're buying part of a pooled fund. And then finally, what I would say is you could buy the royalty vehicles, which provide you, I think, the best of all worlds, which is leverage of the gold price, leverage to exploration success, because the royalties are on the individual properties. And to the extent they are drilled out and grown geologically, you'll get that upside exposure. But what you're insulated from is operating capital cost inflation. And Frank, my argument is right now, we're headed into an inflationary cycle in the mining business as well. We saw this 10 years ago when we saw both base and precious metal companies start to invest significantly in new mine capacity. And because of the downward trajectory in reserves over the last 6 or 7 years in the gold business in particular, that cycle of reinvestment is going to start happening again against the backdrop of inflation in the general economy. And so I do expect there's going to be significant inflation. I think that's some of the hesitancy that investors are experiencing when they're looking at gold mining equities. And so I think the best way to play the gold rally, which is inevitable, we're going to see $3,000 an ounce plus gold. You'll want to buy into the royalty vehicles, in my view, to get the best of all.
Now, for me, and I don't have the experience you have in this industry, right? You're an industry legend. I would argue right now it's one of the best conditions I've ever seen for gold, at least the past 10 years. Would you argue even longer? Because you just mentioned, I'm not even talking about the current conditions with quantitative easing. Everything's out of control. We're throwing around trillions like it's nothing. I mean, TARP was 480 million, right? And that was to save the entire banking system. We're throwing trillions out like nothing, more infrastructure coming. So again, we're seeing massive inflation. The Fed has to say transitory, because if they don't, they have to be raising rates right now. And that's going to force a recession, which is probably also going to be gold as a safe haven, would be a good spot. But also what you mentioned just now is, the reserves where, being in the majors and being involved in the majors, just the amount of spending that took place, a lot of these companies had to deleverage, which resulted in, less reserve, less drilling. For me, it seems like I've never seen conditions like this where people should own gold, but, you've been doing this for 30 years, lived to do tons of boom and bust cycles. I'd like to get your opinion on that.
Well, look, I think you correctly pointed out there has been a diminution of reserves in the gold business because the industry has been focused on deleveraging. There was quite a party 10 years ago when gold and base metals were rallying dramatically post the credit crisis, and base and precious metal companies were building new mines, and that inflated costs dramatically, operating capital costs. And undermined that leverage proposition that investors were looking for as the gold price went up. And gold equities and base metal equities underperformed their underlying commodities. And so they, rightfully spent the last half a dozen years harvesting what they built and getting good returns on that invested capital, returning capital to shareholders, and deleveraging effectively to net zero debt. Mining business is at net zero debt, which is remarkable. That's actually inefficient from a capitalization standpoint, but they overcompensated for the amount of debt they strapped on to build that new capacity 10 years ago, and they returned capital to shareholders. And so they don't have a very efficient balance sheet right now, though they are substantially deleveraged. They're well cashed up. And so they're going to have to put that capital to work in the ground, because what we've seen is a 40% decline in gold reserves over the last 7 years from peak reserves. Inevitably, that'll lead to diminishing gold production. And that's likely to stay in place for at least 8 to 10 years, because, from discovery to first production and any new gold deposit, you're looking at 10, 15, sometimes 20 years. So we're not going to see a reversal in that downward trajectory in production for the foreseeable future. But the industry has to replace their depleting reserves. And again, that's happening on the base metal side as well. And given the robust demand we're seeing for copper and other base metals, as we look to decarbonize the economy, because we need those metals to decarbonize, we're going to see significant investment in new mine capacity and a significant inflation in both capital and operating costs. So again, the way to play gold, in my view, is either owning the physical or owning gold royalties that provides you, again, physical exposure, but also the upside to the exploration that the underlying operators achieve through the reinvestment in the ground in new exploration targets.
So you are the former president CEO of Goldcorp, right? You helped with the merger with Newmont in 2019. I think you were there for 3 years. Over the past 30 years, numerous executive positions. I would think after this merger, you could have done two things. One, you could have just retired, or two, I'm sure your phone was ringing off the hook with offers, and yet you go to, relatively a startup, which is Gold Royalty. What did you see in that company to say, hey, you know what, some people love the startup atmosphere, and you've been on the other end of the spectrum with running a very large company, and say, hey, I love that startup, and there's a lot of excitement and a difficulty in bringing that to market. But what were some of the things that you saw that for someone who could have took a job, I think, almost anywhere, for you to go to Gold Royalty, I think that was such a huge story.
Well, it's kind of you to say, and I've spent the last 30 plus years in operating roles. I ran Goldcorp for 3.5 years. I ran Hudbay Minerals, a base metal company, for 6 years before that. Was with Agnico Eagle for 12 years. So I've spent 30 plus years in building mines and been involved in the construction of 15 mines across the world, and operated countless more of those. So I have come from an operating perspective. And what I've done is made a macro call about where we need to be at this point in the gold rally. I think we're going to have a sustained gold rally for a number of years, given, as you correctly pointed out, the need for governments to continue to print money and keep interest rates low. But I think where we want to be positioned, where I wanted to be positioned, is at the development end of the spectrum. And because of the significant underinvestment we've seen in both base and precious metal companies into new mine capacity over the last half a dozen years, I recognize the need for companies to build mines again. But I didn't want to be exposed to what I think is going to be an inflationary cycle in mine input costs. And what I wanted to be is at the end of the spectrum that provides capital to the mine builders, developers, emerging producers. And really, that's what royalty companies have done in past cycles. They've acted as the dedicated bank to mine developers. And what I've tried to do in assembling the team that we have at Gold Royalty is put together a team that has operating expertise, not just financial expertise. If you look at the board and management that we've assembled, collectively, we have over 300 years of experience in mine operations and development. And I want to emphasize that, mine operations and development. A lot of other royalty companies are being run by people that have done nothing but build spreadsheets their entire lives. They've never built mines. This group, this management and board, has built mines, countless mines. So they have that kind of expertise, which serves two purposes. One, it gives us a clear-eyed view of and perspective on the underlying risks of the mines that we're financing. So we do I think, extensive due diligence, and we're in a good position to do that because we've been in their shoes. We've been builders and operators. But also it gives us access. Having people with this kind of tenure in the mining business gives access to royalty opportunities that might not be available to the general market. We don't want to get involved in auction processes where royalty opportunities are bid up to astronomical levels, which undermines the rate of return proposition. So, like the deal we announced last week with Monarch, where we picked up royalties in the Abitibi region in Quebec, one of the most prolific gold districts in the world. That was a bilateral discussion through a relationship we had. I worked in the Abitibi for many years when I was the CFO at Agnico, so it gave me access to people that I knew there, and I got in front of royalty opportunities before they were available to the marketplace. And so we're allocating that capital, expecting to get double-digit rates of return as a result. So, again, the macro call is get involved at the development end of the cycle. That's where the action is going to be. That's the macro call, but in doing so, make sure that your shareholders are not exposed to the underlying inflation risk and input costs on the mining side, which I think is inevitable. And what I liked about the gold royalty portfolio is it had a significant mineral endowment. We had 18 royalties with an underlying reserve and resource position of over 32 million ounces of gold equivalent across the Americas in low political risk jurisdictions. That's a great foundational element to build your royalty business from. And that's how Wheaton Precious Metals was founded 15 years ago when it was spun out of my former employer, Goldcorp. It had royalties and a collection of Goldcorp's assets. That provided the foundation from which it diversified and grew into what's now the second biggest royalty and streaming company by market cap in the world. And it's not a coincidence that Ian Telfer, who founded Wheaton Precious Metals and founded Goldcorp, is now the chairman of my advisory board. He brings that expertise, that institutional memory. He pioneered the whole streaming model, and we've got him on board. So it's not only important to have that foundational element of reserves and resources that we inherited in the spin-out from Gold Mining Inc., but having the right people that have done this before and have the mine operating expertise, the expertise in founding large cap mining companies on our board is, I think, a significant competitive advantage relative to our peers in the royalty space.
Yeah, that's pretty cool. I don't think there's too many people that could say that. I don't know if I'm saying this correctly. If you're the boss of Ian Telfer telling him what to do, but that means you're pretty high up there.
We're peers. We're peers. I would never call him my supported for sure. He's eminence grise of the mining business, and we are super lucky to have him not only as chair of the advisory board. He's one of the founding shareholders of Gold Royalty Corp as well. He was a significant investor in our IPO and our pre-IPO round of financing as well. So he's put skin in the game here.
And you talked about it briefly, and I love the inflation argument because you really don't hear that cost and inflationary environment within the cost structure of why royalties are better to own right now, right? You hear, well, you always hear, lower risk of development, almost no risk of development. You just lower capital costs in terms of, a few people running it. It's more like a finance company. But just for seeing that, which is definitely happening right now, which is the massive amount of costs that go into mining and that inflation and being immune to that through this, that's a great argument, right? So it's such a great argument that you're seeing a lot of competition in this space. Is it difficult to find good royalties, good projects where you have the majors? And I felt like the streaming companies did a great job when the majors were kind of, I wouldn't say in trouble, but they were deleveraging and, trying to raise capital. And I know they've given away some of those projects, which was easy. Now they're fully capitalized, like you said, no net debt. It's incredible how strong these companies are. And then you have other companies forcing, their way into the space, specifically in gold and royalties. How difficult is that environment, and how much does it help to have a person with you, credibility, Intel for you have that advisory board, when I'm sure if you're calling someone, they're going to always pick up the phone for you?
Yeah, look, I think that is a tremendous competitive advantage. And you're right, there has been a proliferation of new royalty entrants in the space over the last couple of years, recognizing that the juniors and emerging producers who've had difficulty accessing capital need a means to do that. And the royalty and streaming companies are trying to provide that means. There's been too many of them that have been introduced into the space. There's going to be a rationalization, a merger and acquisition cycle that's likely to happen over the next year or two. And we're leading the way. We announced our merger with Ely Royalties a number of weeks and months ago, which we hope to close later in August, and that will more than double our market cap and increase our royalty portfolio fivefold from 18 royalties to over 100 royalties. And now with the acquisition of Marduk, we're going to be at about 106, 107 royalties on a pro forma basis, which puts us at the leader as a leader of the pack post the merger with Ely. So we've started the music. It's musical chairs now. We saw rationalization and merger activity in the royalty and streaming space about 6-7 years ago when we last had a cycle of new entrants into the space. Now we're going to see that rationalization again, because the name of the game is to lower our cost of capital, because effectively we're acting as a bank for the emerging producers and developers in the space. So it's important to maintain our competitiveness by having low cost of capital. And the way to get low cost of capital is to get a re-rate, get big enough so you attract more traditional institutional investors into the name. That drives up our multiple, drives down our cost of capital, makes us more competitive as we bid on new royalty opportunities to supplement what's already a very impressive portfolio of royalties and streams.
Pretty obvious here, and this question could be obvious to you and me, but let's talk to everybody else out there who may be a little bit familiar with royalty companies, because when I look at the cash that you have on your balance sheet, and I don't know if it's updated because I know you guys just did a deal, which is $58 million. I don't know if that's included in your deal that you've done only a few days ago. I think this presentation might be, a little bit older than that. But when you look at this chart here and having this amount of money, I mean, the leverage that you guys have to really get into deals, to really sit down. Now you have, great management team, credible, everyone knows you throughout the industry. You're sitting down. They know you have cash. Explain the importance of that. I know that's a simple question for you and I, but people out there, you have to, when you look at royalty companies, I mean, the balance sheet is just as important as the current royalty streams.
Yeah, we have no debt. That's the other thing I would add is we have the largest cash balance. In fact, today our cash balance is closer to $90 million US. And after the Ely merger, some of that cash will go towards completing the Ely merger, and we'll end up somewhere between $30 and $60 million in cash pro forma, depending on what Ely shareholders elect in terms of receiving cash or stock. They have an election to do a combination thereof, or all cash, all stock. It's up to them. So we're still going to be extremely well capitalized even after the merger, and we're going to have cash flow. We're going to have 4 cash flowing royalties today. By next year, that will more than double. Our trajectory in terms of cash flow, we'll see our cash flow increase 5 to 6-fold over the next 5 years. And so we will have access to cash flow, no debt, and very little in terms of G&A costs. Our business is eminently scalable. I'm going to have, after the Ely merger, 6 full-time employees. I could run a business 10 times the size of the one we're going to have post the Ely merger with the same employee base. So every dollar we add in terms of our royalty revenues is going to go right to the bottom line for our shareholders. So not only will it give us the ammunition to do more royalties and compound returns, but over time, we think we're going to be in a position to introduce a dividend.
That would be incredible. People love dividends. Even if it's like a 1% dividend, people just love it, right? It's kind of crazy, especially because
it shows that your business is sustainable. And that's what we have, is a sustainable business model.
And let's talk about that. In the future, what you plan to do. But I think you have royalties in 5 countries right now. Are you limited to the countries, or it's like, hey, we're going to go anywhere we think we can get a good deal? And of course, I know, especially you would know, some of these areas you probably avoid at all costs with their governments. But are you limited to that? And what are some areas you may be looking to explore? And because there seems to be a lot of projects out there, but again, like I mentioned earlier, there is some competition. I'm sure other people looking at those as well.
Yeah, look, what we have, I think, which distinguishes us from a lot of the royalty companies, is extremely low political risk. We're even after the Ely merger and with the Monarch acquisition, which we announced earlier this week, we are 100% in the Americas in low political risk jurisdictions, and more importantly, jurisdictions that welcome mining, that have a rational regulatory framework for mining. We have strong geological models underlying our royalties, big resources, significant mineral endowments. And so when we're looking at other opportunities to continue to diversify our portfolio, we're focused first on the geological model. We want a strong deposit with significant exploration upside. That's what really provides leverage for our shareholders as they look at investing in us. But we also want to be in countries that have a rational regulatory framework, that welcome natural resource development. And we want to invest also in operating teams that have a track record of developing mines in those jurisdictions. So you may see more diversity, geographical diversity going forward, but I can assure you that low political risk will still be a key criteria for us in any investment we make.
And last question here, which is the most important by far. So do you determine where you're going to buy these royalties based on how the cycling is in these areas? Somebody told me about you being very, very into cycling. You go everywhere around the world. So yes, I had to bring that up. So
yeah, it would be helpful, but I promise investors that I won't make it a key criteria. I think there are more important criteria than where the best mountains are for cycling.
No, that sounds great. Well, David, thank you so much for coming on. I mean, you're a big name in this industry. I think, with Mir Adnani, very lucky to have you, Chair CEO of Gold Royalty, and feel free to come on whenever you want to update portfolio. Seems like you guys are in great position, and wish you guys the best of luck.
Well, I have to say, I'm lucky to have Amir as a partner because he had the vision to found gold mining 10 years ago, buying at the bottom of the cycle. And that's what underlied our royalty portfolio. If he hadn't accumulated those assets at the bottom of the cycle, I wouldn't be in the position I am today to create the royalty vehicle we have. So I'm lucky to be a partner with him, believe me.
No, well said, well said. Well, thank you so much for coming on. Hopefully you join us again soon.
All right, thank you.